Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So Bloomberg published this week its monthly update on Street Strategists' 2026 estimates for the S&P 500, for both the index close at year-end and full-year EPS. The median index close at December 31st is 75.50, some 10% above the current level. Not a single strategist of the 22 surveyed see the index falling between now and then. Two of the 22 have the index ripping above 8,000. On the earnings side of things, the median is $308 a share. That's a healthy 14% above the $269 level 2025 is expected to hit. The high is $320 a share, the low $278. Once again, no one sees earnings falling year over year. It's all good, right? Well, this week, our three things are: 1. Delinquencies warning. Is that really a thing? And 2. Utilities unicorns. Can a sector be both defensive and growth? And 3. K-shapes. They're present in places beyond the consumer. All right, let's dig a bit deeper. Delinquencies warning. The Bloomberg headline jumped out. U.S. consumer delinquencies jumped to highest in almost a decade. Well, that reads as a bit of a shock, given that unemployment, 4.3%, the statistic that intuitively syncs up with delinquencies, is well below its long-term average of 6.1%. The delinquency report comes from the newly released New York Fed's quarterly report on household debt and credit. Aggregate delinquency rates, that's 30-plus days past due across all consumer lending types surveyed, rose to 4.8% at the end of December, 0.3 of a point higher than September's close, and yes, the highest since third quarter of 2017. What do we make of this? Well, let's peel this onion a bit. For context, the 20-year peak in delinquencies is 11.9% hit in the fourth quarter of 2009, so the current level of 4.8% is not all that worrisome. When we look at loan-level data, we find that student loan delinquencies are spiking, really correcting, after COVID period forbearance. Transition into 30-plus days past due among student loan borrowers hit more than 16% in the latest quarter, up from less than 1% as recently as year-end 2024. The previous peak in this dataset, going back to 2004, 11.6%. This has become an issue. Student loans account for 9% of total consumer borrowing. Delinquencies are also rising in mortgages, where the current level of 3.8% is the highest level since the fourth quarter of 2015. But that level remains well underneath the GFC peak of 12.4%. Fed researchers note that delinquency rates from mortgages are near historically normal levels, but the deterioration is concentrated in lower income areas, again, evidence of the K-shaped economy, and in areas with declining home prices. On the auto finance side of things, we've noted in the past troubling trends in subprime auto delinquencies. Total auto delinquencies in the latest Fed report are hooking lower ever so slightly. Anecdotally, consumer loan delinquencies are generally flat to down year over year among the large lenders in both prime, superprime, and non-prime in credit cards, auto loans, and personal loans. We attribute the improvement to two factors. One, tightening of consumer loan underwriting standards by lenders during COVID, after seeing an unexpected rise in bad debt in 2022 and 2023, and two, the better-than-expected economy of late, including low unemployment and growth in consumers' real net income. Overall, loan quality trends in consumer lending are well in line with lender and investor expectations. There is little evidence of credit crunch. In fact, borrowing continues to hit new highs, which is important when we think about personal consumption, the single most important factor driving economic growth. All right, on to our second thing, utilities unicorn. I bet you never thought you would ever see unicorn and utilities in the same sentence, but here we are. The ultimate defensive sector, regulated with high essentiality, is also a growth sector, courtesy of the surge in demand, demanded by, among other things, the AI build-out. The utility sector in the S&P 500 hit an all-time high this week, and while its forward earnings multiple was higher during COVID, at 18.5 times currently, it's 2.5 turns above its 20-year average. Utilities are on pace to record the largest sectoral upside surprise in Q4 earnings, currently running at plus 5.5% actual versus estimate. And maybe that's a sign of things to come. Earnings growth is expected to go from 8% in 2025 to 9.5% in 2026 to a whopping 32% in 2027, according to FactSet. What's behind the growth? Record CapEx that will lift the rate base, along with improved operating leverage captured from a surge in demand from electrification of data, vehicles, and factories. Ordinarily, elevated CapEx could pressure leverage. According to Capital Group, upwards of $1.2 trillion will need to be invested over the next 5 years. Factor in $200 billion of dividends, and the sector figures to be cash flow negative to the tune of $500 to $700 billion. The good news for bondholders is that the sector's regulatory support, as well as highly aligned revenues and expenses, effectively limits material degradation of the balance sheet, paving the way for broad access to secured and unsecured debt markets. In a year where geopolitical uncertainty is running high and corporate event risk, leveraged recaps, is reemergent, the utility sector is a natural defensive play, with a growth engine to boot. All right, on to our third thing, K-shapes. As in plural. Our world has adopted K-shape as the way to describe the bifurcation among consumers. A top prong doing well and driving spending disproportionately, and a bottom prong that is struggling with inflation, struggling with higher interest rates, and now struggling with student loan repayments. But we see K-shapes elsewhere. In commercial real estate, for instance, where the office market has been tested against secular changes. First, work from home, and now concern over what AI means for the property class. The premium end of the office market, the top prong of its K, is showing expansion in the most attractive markets, while the lower prong continues to struggle. The level of distressed office real estate has reached levels not seen since the GFC. We also see a K-shaped phenomena in small business, where the ability to manage higher costs on labor, materials, and financing present headwinds that are more impactful than is the case with larger-scaled businesses. Not surprisingly, CapEx spending is overwhelmingly concentrated among the largest firms, and much of that is concentrated among technology firms. What this means is that U.S. growth is more concentrated today than has been the case in decades. Wealthy households riding a historic rise in stock markets drive half of total consumer spending. The 10 largest firms in the S&P 500 account for a third of the index's earnings, and AI-related investment accounts for roughly one-third of economic growth. Many are calling for a broadening out of economic activity in 2026. Look no further than the recent significant outperformance of the equal-weighted S&P 500 and the Russell 2000 relative to the cap-weighted S&P 500 index. We're in that camp, albeit cautiously. Our takeaway? Don't lose sight of the bottom prong on those Ks. They will matter. So there you have it. 3 things in credit. 1. Delinquencies warning. They are rising, but well within normal ranges. 2. Utilities unicorns. For those leaning toward up in quality, this defensive sector with significant wind at its back makes sense. And 3. K-shapes. We're seeing more and more of these turn up. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.